Hello and welcome to FidelityConnects. I'm Pamela Ritchie. Canada's energy sector could be getting a boost with a proposed oil pipeline to the BC coast. It's a new pipeline that is being discussed. While some are not happy with this deal announcement, others are calling it a moment of opportunity. So how is our next guest navigating the voices of competing interests and finding pockets of growth ultimately as this gets discussed? Joining us here today to dive deeper into the global energy and U.S. industrial sectors is equity research analyst Jin Hwang. Welcome back. We haven't seen you, I think, in a few months, Jin, but it's great at this moment to have you sitting in the chair. This deal MOU was announced yesterday. I think most people have seen this. Is it? It's a surprise. Does it mean a lot for the Canadian oil industry? Will it shift everything?
Yeah, so first off, it's a very positive signal that we have a government that's supporting the development of probably our most highest value resource in this country for the first time in probably 10 years. If you just think back at the history of Canadian energy, we went through a period over the last decade where we have all the resource in the ground in the world. If you look at the top 10 largest reserves in the world, Canada is squarely number 3. And anyone else within the top 10 is either fully depleted within inventory, i.e. kind of the US of the world, or are largely in uninvestable spaces within the public markets context.
Meaning sort of from a political standpoint, it's hard to buy from them,
correct,
essentially?
Yeah, we're talking about the Irans, the Venezuelas of the world, where they might not have a developed public markets type world. And Canada had this weird balance between we have a lot of resource in the ground, but we can't take it out because we don't have the export capacity. So for the last decade, that's just been the case.
The story has been stranded assets, although some gets out, but it's never been this growth story, really.
So we were in this period where we weren't able to grow, we weren't able to ship this much needed crude to markets that needed it, like the Africas or the Indias of the world. And that was the struggle of this sector. Come last year, we spoke about this, I think probably the last time I was here, but the TMX pipeline changed that dynamic entirely.
Right.
That added about 600,000 barrels a day of incremental export capacity that got used up almost immediately. We are shipping crude incrementally to Asia beyond just the United States. And for the first time, producers had some optimism that the sector would be able to grow. That was fairly short-lived. We used a lot of that pipeline capacity fairly quickly. But with the next steps that the government's taking here now, we're now looking at potentially 1 million barrel per day pipe going out to the West Coast and additional expansions beyond that. So we are now talking about a world that went from no growth at all to very little growth, potentially kind of large swaths of growth in a very short period of time. So it is a very exciting period for energy.
And just put us back into sort of the Canadian story. So you've been joining us and telling us a little bit of the story of the transformation of the oil companies, of the energy companies for the last several years. They have not been as tied to the price. Better balance sheets. They just look like more sort of stable, don't need to invest with the price of oil going up and down so much.
Right. Yeah, the history, and it's evolved so quickly in just the last 2 decades. We went from the early to mid 2000s where we talked about this idea of resource scarcity. We actually didn't know where the next barrel of oil was going to come from because China was growing so quickly, India was growing so quickly. We had a capital intensive global economy and we just didn't know where that was going to come from. That was the first phase of evolution for the global energy sector. From there, we hit the speed bump period of US shale, where all of a sudden we had this unlocking of new supply in the US that met every single barrel of demand out there. And it became
flooded the market, basically.
Flooded the market, regardless of if it's even economic to pull it out of the ground. So we had this period of undersupply going to massive oversupply through the 2010s, and then COVID struck. We had negative oil prices. Nobody was buying oil around the world because everything was locked down, and all of a sudden these companies were on the brink of death.
Do you remember that day when you just watched US oil, that ETF just actually
everyone
underwater?
Had their views of if negative was possible, and sure enough, we hit it. But at that point, there was kind of a redefining of the sector where they said, you know what, we can't grow at all costs. We can't inflate our balance sheets to no end. And that's when Energy 2.0 came in, where I'm going to reduce my leverage. I'm going to pay out more of my cash to shareholders. And every barrel that comes out has to come at a very specific return threshold so that we are valued as better businesses. So for the last 2-3 years, we've been kind of in that Energy 2.0 world for the sector. As we think about going forward from here, look, the short term of the oil price world is a little choppy. There's a lot of new supply, which we can talk about. Longer term, though, we may still be having that conversation again of resource scarcity. By the end of this decade, we might not know where that incremental barrel of oil is going to come from because the US shale boom is starting to slow pretty dramatically.
It's sort of hard to believe that in a sense because we have gotten to that point where we think the world is, floating on oil to some extent. And when will that supply ever really shift? The price of oil has done has reacted to that. So it's hard to believe that in a matter of years, we're actually not going to know really where the next barrel of oil, what's happening there.
It's entirely shifted, and it's because of the deceleration of U.S. shale. If you went through a period where you were drilling all your best stuff very quickly because the price of oil was $30, $40, $50 for most of the last, I guess, 15 years.
And emissions meant nothing.
Emissions meant nothing. You deplete your inventory, your resource super quickly. But in today's world, because you've already drilled a lot of your best stuff within U.S. shale, the costs naturally start going up. You have to drill a little deeper, you have to drill a little longer to get that incremental barrel. I think the last forecast that I saw was from a third-party data provider, but today to take out a barrel of crude from the Permian Basin or from U.S. shale more broadly, to generate sufficient returns, you need oil prices roughly in the low 60s. The expectation is because you're depleting that good stuff today, by 2030 that could be 75, and by 2040 that could be 95. So that curve sort of tells you the depletion of the U.S. shale resource is starting to materialize potentially into higher oil price in the future. And if that's the setup, we will have the question of where will that next barrel of crude come from?
So in Canada, if we get new pipelines, it could be one, it could be more. I mean, they seem to be opening that gate up, so we'll see. But where is the demand coming from, or can you be specific about that?
Yeah, it's globally. For the longest time, we thought oil demand might plateau in the 2030s. That's what the most onerous reports out there would say, and it's because of the electric vehicle penetration rate globally. We're seeing it in China, we're seeing it in the United States. I think what the analysis failed to reflect was the rapid growth of the emerging economies, called the Africas, the Indias, the South Americas of the world, which are more capital intensive, they're more industrial driven, and that's going to naturally lead to a longer tail of oil demand growth. And
not EVs.
And not EVs necessarily. That's an entirely different question, because with EVs comes a need for more power, and as it looks today, we are kind of power constrained because of all the fun AI narratives that we have out there. But because of that, the latest forecasts now say oil demand might grow until 2050, and that's a recalibration of the calculus that we previously didn't really think about.
It's so interesting. So EM, in fact, may power a longer oil demand, and there aren't as many countries that have the oil. Canada sits closer to the top. Would be at the top. Really, seriously, we'll be at the top.
Well, in terms of resource and ability to execute on the resource with the help of kind of private markets, Canada, again, we have the third most resources in the world for crude. We have a supportive government. We have clean emissions regulations that overlaps around the entire sector. Put that all together, and it's the most natural source for economic growth within energy production.
So it's a global demand picture. For instance, if you think, it's too far away to supply oil to India, for instance, or whatever, or India would be faster than to get it from Iran, or, and those are all politically sensitive discussions. But the idea is there will still be other demand that then has to be filled.
Yep, 100%. And again, for all the short-term headaches that we're seeing right now, it's been a super volatile period for oil prices this year. Guyana, Brazil, Argentina, Canada, now even OPEC, they're flooding the market with barrels. We may enter peak or kind of all-time highs and surpluses for next year. But by the end of 26, as we look into 27, 28, those same sources of supply start to decelerate pretty quickly. We actually don't know if 28, 29 will be properly provided with respect to oil. And we could start talking about deficits. And it's not because I think oil demand or forecasts suggest oil demand is going to take up. It's just a steady climb as it has been going for the last 20 years. And as demand grows, you need more barrels to kind of support that. And we just don't necessarily know where that's supposed to come from. And that's exactly where Canada can fit into the picture pretty cleanly.
Can I ask you, so Canada is obviously not part of OPEC. OPEC is a different group, OPEC Plus.
Yep.
They're controversial, useless, some people say. It depends on who you ask. But in any case, they exist as a consortium.
Yep.
Do you think that will break down? And if Canada becomes, bigger on the scene, there'll be new discussions of consortium? I mean, how is that shifting? You must watch the different alliances within the oil market as well.
Yep. To be frank, no clue if that breaks down. I'm sure people have called for it many, many times.
Yeah,
you see countries leave the coalition, you see countries enter the coalition. What we do know is that they have an incentive for higher oil prices over time.
Right.
And because the last 5 years they've had so much capacity that they've had to take off to support oil prices, we haven't seen that materialize into higher oil prices. Saudi we hear about the break-even number to balance their budgets.
To balance their budgets,
$80, $100, people throw out all sorts of numbers. That hasn't manifested into oil prices because they've had so much stuff taken offline to support the post-COVID world when everything was still recovering. By the end of 26, because of how much stuff they're bringing back to the market now, we might be saying, you know what, they actually don't have spare capacity to bring onto the market anymore in a way where they can't be the counter argument to every single geopolitical event that you talk about.
Right.
When we see the Iran news, we see the Ukraine news, we see Russia, there's always a fear that global oil supply will be disrupted in some way. But the counter argument has always been, yes, but OPEC has 6 million barrels a day of spare capacity. This year, they decide to unwind a lot of that, and they're going to do so increasingly through next year. So by the end of next year, we might not have that argument anymore.
So why are they doing that? I mean, knowing that
Yeah.
they're reading the same numbers as you, that it could be growing, they might want to hold on to a little bit of it.
Yep.
Why are they doing that? They're transitioning themselves?
There's a lot of speculation on it, and we can go down those different paths. I think the idea is this has been a market share focused type of coalition for the longest time. And if you can wedge all of your excess capacity in now, why not do that, knowing that if you don't do it yourself, then someone else is going to displace your barrels. But
so really interesting time for Canadian producers
Yep.
right now, the pipeline companies themselves. Who is going to ultimately fund this pipeline? I mean, we don't know. This seems
Yep.
to be one of the many question marks of the MOU announcement yesterday. But who probably will step forward and
Yeah.
fund this? Because it sounds like it's being tossed to the private sector, and
Yep.
that's good.
So before we go into the pipeline itself, it's important to note that we talk about Canada having a lot of resource and having the growth opportunity in front of us. Even putting this new pipeline aside, we have several pipelines within Canada that a lot of these pipeline companies are talking about expanding,
Right.
i.e.
Twinning,
twin lines,
yeah.
add some pumping capacity, things like that. This is stuff that you're not digging new ground for necessarily. It's a lot easier to do from a permitting perspective. It's cheaper to do. And on those projects alone, we might have capacity for 1 million barrels a day of growth. If you think about Canada being a 4.5 million barrels per day exporter today, 1 million barrels just changes the calculus entirely. So even before we talk about the extra million that we announced yesterday, we already have a lot of visibility. In terms of who's going to build that next million, it's difficult to say. The government has said they want a private market solution to it with co-ownership from the indigenous groups. But the most natural kind of buyers of an asset like this are going to be the existing pipeline companies.
Okay.
The challenge that you face there, and this is actually a good problem to have for the pipeline companies, is because of the gas renaissance that we're seeing, all this excitement around LNG, AI, data center demand, they have so much capital they can deploy within that space in the US and Canada that they don't actually need to do something like this. They're doing smaller projects, bite size, at really high returns. We're looking at returns of
using natural gas to steam it out of the ground and all that kind of thing.
Yeah,
They can just go ahead and use
even
it.
just adding an extra line going to a power center that might have been coal before and now it's gas, but you make good returns just building an extra connection. So they actually don't need to do this. So it's sort of incumbent on the government to pitch a $20, $30 billion plus type project to these pipeline companies so that they can put some of the gas stuff aside and they want to willingly build this. That's going to be the challenge. And I think if we see the world where we need more crude oil kind of globally and there are deficits and resource scarcity conversations, it might be easy to actually have that conversation with the producers to backstop something like this so they can go to the pipeline company and say, you know what, we don't need this capacity today, but we don't know where the next barrel of oil is going to come from. We're going to provide that to the world, and we think we need the 1 million barrels, and you can sign a contract to help support that.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Can the government in some, it depends on who you ask and at what point, but it seems like there's a shift that they would like to have made away from natural gas, providing a lot of that energy for it to be nuclear. I mean, that's sort of another step and another piece, and I don't know if you follow that as well, but is there some sort of sweetener or a shove that the government can push them in that direction as well?
Yeah, we have a lot of levers here. What's interesting about today's world relative to even 3 years ago is it's not just one source or the other. It's actually an all-hands approach on everything. The latest forecasts from the US manufacturers say that peak power demand in the US is going to outpace capacity by 2028 because of all this new demand that we're seeing from data centers and power centers and things like that. So if we're already constrained on one, it's not just going to be we can go all in on natural gas. You will have to find alternative solutions, and I think that's what the government's trying to support.
With all the LNG investments and the gas price still on the floor, it doesn't get up off the floor, it seems. What do you think about within that industry? I mean, in terms of investment, how do investors approach the gas industry?
Yeah, there's a lot of ways to approach the gas industry today. We can look at Canada specifically, US, and then sort of across the broad space. Within Canada, it's been a tough space, just like oil. We have tons of resource in the ground, but we just can't get it out. LNG Canada Phase 1 was kind of the first step in the right direction. That came online this year and it's still ramping. So if you're to think about broad strokes, Canada is about a 20 BCF a day kind of gas production market today. Roughly half of that is domestically consumed and half of that is exported.
Okay. Mostly consumed by the oil producers?
Oil producers, power generation, things like that.
Okay.
If you think about the slate of projects, even before this current government came to power, but the next slate of projects from the LNG side in Canada, we're looking at about 5 BCF a day of incremental export capacity that could come online over the next 10 years. That is 50% increase in your export capacity for the entire basin. If you start layering in incremental projects that maybe the Carney government wants to support, we spoke about Churchill LNG way back. This is additive to an already kind of growthy picture that we haven't seen in Canada for the last 20 years, realistically.
Further demand.
Exactly.
So it will bring that price up,
so
we think.
It's more of a timing question than anything else. But if an investor can and is endowed with kind of the ability to look past a 1-2 year horizon and see sort of the picture of the long-term growth here, I think the story within Canada is particularly compelling. As you think about North America wide, gas demand is supposed to grow 40 to 50% over the next 10 years. Most of that is LNG capacity, but then you have coal to gas conversions, things like that.
Right.
This is before we even start factoring in the AI data center narrative stuff out there, which could be multiples more than that if we really think about it. So the picture, just from a demand side, the first time we're seeing real acceleration in kind of natural gas demand is sort of the main story here.
So everything you just laid out there in terms of what will cause demand to creep up and therefore probably the price. Then layer in nuclear, because nuclear seems to be, again, something that's pretty long-term out there. And in the meantime, it will be natural gas until people can build whatever they need on the nuclear front, if they do.
Yeah.
So that is the extra data center piece. They'll use nat gas until they get nuclear. There's got to be a crunch in there somewhere.
Yeah, it's not even just natural gas. It's everything.
It's
as
everything,
I say, it's an all hands approach. One of our PMs likes to say, like, any power is good power at this point.
Right.
Solar, wind, that may have been dirty words in the past. It's not that reliable, but when we're facing deficits potentially as early as 2028,
plug it into anything,
every source of power is going to be additive here. And the only constraint that we have in all of this, it's not necessarily the molecules on the ground, it's not demand, it's actually the infrastructure side of things.
For sure.
To get those molecules from the origination point down to the demand center is actually extremely difficult. If you look at, for example, turbine capacity for natural gas plants, the backlog for that goes out to the early 2030s. Basically, if you want to build a power plant, it already takes a couple of years, but to get the turbine on the ground at your site, you're gonna have to wait till probably 2033 at this point. So the demand is unlike anything we've seen for a very long time. And again, while the short-term movements may be volatile, the end direction and the long-term path remains very, very positive.
So, but ultimately, the oil producers will probably fund this pipeline. Is that where the money is going to come? Because, I was going to throw out there the pension funds coming in for this, for infrastructure, the pipelines themselves. Like, where is this money likely? Which pool is it likely to come from? Or do we have foreign direct investment saying, wow, this is a great idea?
As of now, the most likely candidates are probably kind of the large infrastructure companies. And the large infrastructure companies, again, it is a balance because the project is there, it's likely needed in a 10-year time frame, but they need the contracts in place to make sure that they're not taking speculative risk on a pipeline. Right. The last time we built a new pipeline in this country was kind of a disaster.
It was a disaster.
So you need protections against that. And so it is a kind of all hands approach again between the producers who need to grow enough to fill that pipeline and also the infrastructure company to take on the risk of building that project. And you can't have one without the other. That's kind of their approach. I think the Carney government, their approach is kind of production, pipelines, and sort of pathways. You put those three together and you will be able to grow Canadian energy production pretty sustainably over time.
So the producers have been involved in pathways for years and years at this point. This is nothing new, but it does seem to be bringing on a new role, piece. Is there anything that you want to say sort of from an investment perspective about this Pathways project being contingent, or each of them being contingent on one another? Is it that's good for investors?
If you were to just think finance 101, discounted cash flow is effectively the value of a business. The more you can pull forward those cash flows to an earlier period, the more valuable your business is going to be. And if we're talking about 90 years of resource, that 90th year of production that a Canadian producer would have is not worth that much. If you can pull that forward to the next decade, that just changes the calculus on these businesses entirely.
So when is it too early to invest this story? Today is too early. That's why you started out saying, short-term choppy, longer-term better.
Yeah, so the challenge there is I'm speaking only in directionals. Oil prices are probably the hardest thing to predict out there.
I know.
And so the way I'd frame it is, again, short-term, it does look sloppy. Again, the Brazils and the Argentinas of the world, they are contributing a lot of incremental supply that is not necessarily needed today. But a lot of that does fade away by 27, 28, 29. And unlike the shale boom 2014, 2015 period, we have an end in sight as to how this is going to resolve itself. Eventually, this production does come off. Eventually, demand just keeps growing, and we're going to grow our way out of this current issue. This is a very different period. If you read any prior research from the 2014 period, nobody knew when this would end. So is it too early? Potentially, but at the same time, if you don't think you can predict oil prices, which I don't think anyone reasonably can, and you have a long enough horizon here, i.e. more than a year's worth of runway, I would say this is the opportune time.
This is the time to sort of get in there and start looking around. Certainly. Okay, so there's a bunch of questions coming in, which is great. You see which ones you can answer. Necessary conditions, or what conditions are necessary to close the price gap between WTI and WC at Western Canadian? What do you see there?
Yeah, so those will always fundamentally be, there's always going to be a delta between those two, only because the cost of getting the crude to the US is one thing, but equally the quality of that crude is lower. The reason that so many refineries in the US, I think 60%, 80% of their refining capacity in their key markets are heavy crude oriented, is they consume it for the cheaper heavy crude that they can process and deliver into gasoline and diesel and things like that. Without that discount, those refineries don't work anymore. So there's always going to be a fundamental price difference between those two.
They need it,
right?
In order for it to work.
A healthy price level between those two is always going to be kind of $11, $12. The good thing about today's world is we're at that level today. For the last decade, we've gone as high as $20 plus because there's just been too much production in here relative to export capacity. So in a world where we continue to see $11, $12 differential between those two is actually a really healthy world for Canadian energy.
Because it keeps it rolling. It keeps the whole business case alive. So this question, you can answer it however you like. Which portfolio or fund would you see having the greatest upside to the MOU with Ottawa and Alberta?
The Canadian torqued portfolios will have the greatest exposure here. What's exciting is we're not only talking about a Canadian energy story, but a Canadian story more broadly.
Right.
This is a government that wants to support resource development, infrastructure development, industrial development within the Canadian economy. And if you were to think about the story again, I keep going back to this last 10-year period, that just wasn't the case. If you were to think about the next 10 years from here, the US, they have the data center angle. All these European countries, they have kind of their reindustrialization of those economies. Canadians starting from, it's a very different and lower starting point in a way where small incremental improvements, again, we're talking about small pipeline changes, but the impact to the aggregate is actually pretty massive from the starting point we're at. And if you think about kind of rate of change and sort of the direction of travel, Canada looks particularly good. So it's not just Canadian energy, it's any portfolio that has a lot of exposure to Canada more broadly.
That's fascinating because it's an infrastructure story across the country.
Story, yeah.
Just to go a little macro here, what about the job story? I mean, there's potential for a lot of jobs, and that ultimately goes to sort of lifting all boats.
Yep. And if you listen to the providers of equipment or materials or anything within this boom, they're all seeing exactly what I'm kind of articulating here, and that there's a lot of demand. It's not just a short spurt. It is a very long cycle type of economy that we're looking at, and eventually that's going to materialize into both more jobs, but also higher value jobs.
Yeah, higher value, exactly. Okay, and this question, does this energy resurgence imply lower incentives towards electrification, the supporting infrastructure for that, sort of a general discussion about climate investing, or do you find it's wrapping it all into one?
Nope,
What do you think?
It's all balanced. The only reason there's kind of a license to be able to grow into this is first because we don't know where the next barrel is going to come from, so that's part A. But part B is the Canadian barrel from an emissions perspective actually ranks quite favorably relative to the rest of the world.
Because of the nat gas?
Because of the nat gas, because of the regulations that are imposed on the sector with respect to oil production. Again, if you think about oil production and kind of the supply curve being a global picture, you're going to grow the barrel's either going to come from a country like Iran, Venezuela, where the emissions regulations aren't that stringent, or it's going to come from Canada, where the returns on that barrel is good, the emissions intensity of that barrel is good, and the social development behind that barrel is actually quite good. So those two aren't, maybe in the last 10 years, were in combat with each other, but I think go forward, it's actually supposed to be a bit more in sort of harmony between those two going forward.
And as you said, the demand picture is
demand
behind
picture,
all of that.
It supports it. It's always kind of the rising tide type dynamic, and in this case, we don't know where the next barrel is supposed to come from.
That's amazing. You've hit on this a little bit, but it's a great thing to come back to. What impact will this environment, with what's being discussed, have on natural gas prices? Yeah, someone just would circle back to that.
Yep. So to your point earlier, we've just been on the floor on gas prices in Canada.
They can't get up off the floor, yeah.
I think for this year, on average, Canadian gas prices on a US dollar basis are 60% below that of the US. So we have a lot of resource out there, but just like oil of the last 10 years, we have no way to get it out to the market, which means we're always going to take a discount on it.
Right.
From here, it's going to be incredibly volatile, but what we do know is demand is growing multiple fold over the next sort of decade. I talked about LNG Canada coming online. That's going to be net positive, but the incremental facilities that we have, there's 6 projects in the hopper right now that will come online over the next 10 plus years. That adds 50% increase in your export capacity. Yes, we have a lot of gas. There is a point when that production can't keep pace with that type of demand growth. Right. So one, you're starting from a low enough place where current prices aren't even supportive of break-even economics, but two, you're coming into an environment where demand will continually grow. Put those two together and the direction of travel is positive. When it changes, I suspect when these LNG plants come online from now through 2030. Right. But again, the direction of travel seems quite positive.
And ultimately, what do we need? Because of course, we export it all pretty much.
Yep.
What ultimately does it look like from your perspective, just sort of in terms of how the energy picture for what we need domestically looks? How is that going to change or shift?
That's going to be very contingent on the data center dynamic that we're seeing in Western Canada right now. We've seen a lot of fast development of kind of MOUs and new projects potentially coming into the hopper on the data center side, and that might add incremental gas demand on that side. But what's unique about Canada more broadly is we have a lot of sources for power. And so it's not necessarily just all natural gas to fill that. You look at Ontario, for example, we have nuclear. We're seeing potential expansions to nuclear in the 2030 plus timeframe. And that kind of goes back to the all hands approach that we have here. What's key though is for Canadian gas, it really is increasingly becoming an international export story. Mm-hmm. If you think about LNG facilities globally, Canada, again, you're paying 70% lower for gas prices here. The US Gulf Coast, where they're massively building out LNG capacity, you're paying, again, $4 plus US for gas. It's just a different sort of economic story, both from the producer side, but also from the customer side. If I'm an Asian customer and I can buy the cheap Canadian gas for pennies on the dollar relative to the United States, why would I not do that? So our ability to bridge that gap between what is relatively expensive US LNG versus kind of increasing demands in Asia for natural gas, it's kind of the key part of the story. And again, it's because we have so much resource that is scarce around the world.
Okay, it's really interesting. It's the global picture as much as it is what Canada has to actually provide to that global picture. Any just final remark for an investor who sort of maybe has been sitting out on this for some time and thinking about dipping the toe in?
Yeah, this is, again, I've walked you through the evolution of energy over time. I thought the period where they were returning a lot of cash to us was incredibly exciting because we just haven't seen that from a sector like this before. But in a sector where we are talking about, hey, we're not sure where the next molecule is supposed to come from, and we're sitting at prices today that are below a lot of the break-even numbers that you've heard me quote. Again, low 60s in US shale to grow, we're below that today. You're starting from a point of really good prices with upside, and you're looking at periods where you're going to see demand growth. Theoretically, you put that all together and you're looking at opportunities across the space that we haven't seen for a long time. And it's not just one pocket, it's everywhere. If you hear about the biggest stories in the news today, it is we don't have enough turbines, we don't have enough molecules, we don't have enough infrastructure. All of that leads back to energy. Energy is what facilitates all of that.
The word of next year is scarcity?
Yep.
Yeah. Jin Hwang, it's great to have you here. Thank you for joining us.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Well, on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.